Okay. Hi.
Ken, the floor is yours.
Thank you, Mash. Hi, everyone. Welcome to one of the First Friday sessions. Um, as we're approaching the BFA exhibitions, which will hopefully kickstart the recruitment side of the franchise journey, um, I was just saying to Julie a week or two ago that one of our clients has done really well with the government startup scheme, and we felt that it would be a good topic. The person we've been working with is Phil Archer at DT, and he's going to review the schemes for us because the funding side follows on neatly from recruitment, and so we think it's an interesting topic to be looking at now. So over to you, Phil.
Thank you, Ken, and thank you to the franchise company, and good afternoon to all the guests of the franchise company today at this wonderful sunny day. So, yes, I'm Phil Archer from the DT Group. Recently changed our name to the DT Group from the D&T, which some of you may have heard of before. Um, I will pop up the franchise presentation now and just make sure it is working and get you all ready to share this with me. There we go. So with a bit of luck, maybe if Mash could just nod his head or something just to confirm that that's up. Fantastic. Um, so what we're going to talk about today is funding with government schemes. And in fact, there are two that I'm going to cover off today, just to try and be a bit more complete about it. Um, Firstly, what are we going to, how does this work on here? Right, there we go. So we can talk a little bit about the DT group literally for just seconds. And then we get into the schemes, startup loans, growth guarantee scheme, summary, and then give you guys an opportunity to ask some questions. So the DT group. Well, DT group has been around 30, 35 years now, predominantly in franchising. Probably a good 90% now of our client base is related to franchising. So is either franchisee, franchise or affiliate companies. Actually, we act for quite a few of those as well. We are a full service accountancy company. I am now required to disclose I am not an accountant. So I'm not allowed to let you believe in any way, shape, or form that I am an accountant. I work for an accountancy firm. My background is commercial, is very much more to do with the funding environment for the best part of the last 30 years. Um, we also have our commercial side, which is business plans, funding, and we do business advisory as well. Um, Not really need to say any more about that. The reason I'm popping this up for you guys is so that you can just see, as a business, we cover a lot of the things that factor into this process because funding isn't just about the funding, it can be about a lot of other things as well. So, moving on, the bit that you're all here for. Let's talk a little bit about the schemes. These two schemes sort of come under the guidance of the British Business Bank. They are government schemes in inverted commas. And we've got one called the Growth Guarantee Scheme, which I will come on to second, but I'm showing it first here. Now, I'm being a little controversial here because I'm saying there are four main bank partners for new franchisees. Now, for existing businesses, there are a number of other lenders that offer a growth guarantee scheme solution. But I'm guessing if we're sort of following on from recruitment, we're probably thinking more about new franchisees at this time. So we really are thinking four main bank partners. No secrets about those. Obviously, we've got HSBC, NatWest, Lloyds, and a more recent re-entry to the market is Barclays. Banks can work with brokers. So we as the DT Group are a fully independent broker. We also have many other brokers in the market that are independent that can also work with the banks. And the growth guarantee scheme is a business loan to a business entity. So that's one of the fundamental differences between these two schemes. The startup loan scheme is a lower level loan solution. And the way this works is it's actually handled by 15 different delivery partners around the UK. When an applicant applies on the British Business Bank website, they will be allocated a delivery partner, usually based on geographical location. But we'll come back to that a bit later. It doesn't always work like that, but generally speaking, that's what happens. There are options within startup loans for there's an armed forces version, ex-forces version, and there is also Sharia version as well. Of all the delivery partners, it is my understanding that only one partner works with brokers, and that partner only works with 4 brokers. And we, the DT Group, are one of those 4 brokers. And I believe we're the only professional service provider broker that is actually involved in this. Now, that doesn't mean to say other people don't offer services around the startup loans process. It also doesn't mean that we have a huge amount of opportunity to work with the delivery partner that works with brokers. It's very limited what we can and we can't do. Not like when we're working with banks where we have a much more fluid and much more open conversation with the lenders and sometimes underwriters. The fundamental difference between these 2 schemes, though, is that the startup loan is a personal loan to an individual, and individuals will apply in their individual name. And just the bit at the bottom, which I grabbed off the website, just so everyone understands the structure here. The British Business Bank is owned by the government, specifically the Department for Business and Trade. The accountable person is the Secretary of State for Business and Trade. However, the bank does tend to operate independently with its own board. But of course, there are political guidelines that are coming into the process. But generally speaking, it seems to have been something that has been relatively consistently delivered over the last umpteen years. So let's move into startup loans. As the name suggests, these are for people who are starting new businesses, but they're for the relatively the smaller size end of the market. We're looking at loans here that are up to typically £25,000 per loan. Now, when we speak to the delivery partners, their average loans are nowhere near that. So they're averaging at around about half that level as an average loan, which means there's a lot of these loans being done at a lower level of sort of the 5 to 10 mark as well. The bit that gets quite interesting with this, and this sometimes isn't always known, is that there is an eligibility here of up to 4 loans per business. So that's a loan to 4 individuals who are all running the same business. There are some criteria around that which are quite fine detail, so I'm not going to get into that today. But what I would like to just point out is that we tend to guide people to not do this too often. It is more complicated to go through the process if you are exceeding the 2 per business at 25,000. If you go above the 50,000, there's a whole nother level of underwriting that goes on, and the process does take a little bit longer. And when you're into that level of funding, quite often you've got to ask yourself, am I not better off looking at bank funding? So that's a different scenario. You're eligible if you're a new start, but you're also eligible if you've already started your business, but you haven't yet exceeded 3 years of trading. And it is based on your trading start date, not your incorporation date. So it's quite an interesting part to this process, is that you could have somebody who's already started, who a year later wants to expand their business and actually can come back and use a startup loan. The business model must fit the scheme rules. The basics of this are that the business who is asking for the startup loan must not be receiving commissions or something like that for services it's delivering from third parties. It must be receiving the full revenue for the services it's providing. So you do have a number of smaller brands in the franchising sector that actually fall foul of this rule, because they're actually invoicing direct, taking the end user client's money direct, and then paying MSF or commission to their franchisee. Businesses like that do not fit this model and cannot use the scheme. There is an option for capital repayment holidays. We do use them. There's a lot of logic to this for this size of the market where people are beginning to get their business underway. Can be up to 6 months. Usually we'd only look at 3 because the way it all works and the logic of the underwriting and so on. But it is horses for courses. It's whatever works for whichever brand. Early settlement is possible. Basically, you just get a rebate of interest, so you actually do a better solution if you early settle. There's no penalties as such. You actually get a better situation if you do choose to settle the thing off early. This is the good bit. The rate has been pretty consistent as long as I can remember at 6%. Back when we had very, very low bank rates, it was sort of not quite as attractive in those circumstances. When rates went up, of course, we had the 6% was still there, and rates are beginning to drop back a little bit, but perhaps are going to slow again. So 6% currently is still a very, very good rate for this, and it is a loan for business purposes. There is an online application process. Basically, you can go straight on the British Business Bank website, click on apply, and go through the process. But we'll talk a little bit more about some of this as we go through the next couple of slides. There is a process here that takes about 3 to 4 weeks. So sometimes they can be quicker. I do remember a time where we were getting these approved in under 14 days. At the moment, we're around the 3 to 4 week mark as a guide, and that's perhaps an average. There are a couple of scenarios where they can take a little longer. Maybe there's a little information is required and so on. It's fair to say that startup loans are now slightly trickier to get than they used to be. It used to be a little sort of more rapid, a more streamlined process, but now it just takes a little bit longer. Due diligence is taking a bit longer for the delivery partners. And once you have got your approval, it's an online drawdown, and the money can be in your bank account fairly rapidly within a couple of days. So it is still a very attractive proposition. It does require a professional business plan, or you can use your startup loan template business plan. And that is available, actually, a blank version of that is available on their website. You can do that, but there's quite a lot of work still to even do in the startup loan template business plan. And you do need to have it in such a way that it actually is acceptable to the delivery partner and startup loans. It must cover all the required elements. You need a full background of project narrative. You need your startup costs. You end up with the startup loan template with a 1 year financial projections page. Obviously, if you're going down the professional business plan route, you may well not only have a 1 year, you may have a 3 year plan, which is fine. In this is something called a personal survival budget. And basically what they're looking at here is your disposable income as to whether or not if the business failed, you would still be able to service the debt. Your contingency plan. So what is going to happen if you start this business, it doesn't work? Can you go back to your original job, your original work? And again, can you service the debt? Because at the end of the day, this is a loan. It is not a grant, and it is something that will need to be paid back. One thing that happens regularly with startup loans is that they will look at personal bank statements. And when you're doing your personal survival budget, I mean, you don't have to be to the penny, but you do have to have your budget pretty much in line with your bank statements. So it's very important that people do that. And as brands, if you're explaining this to your franchisees, you need to make sure that they do actually look at their business, their bank statements, and make sure this is pretty much where they're correct. It is important. There is one other element to this with the bank statements, and we have seen it a couple of times this year, actually. The statements arrive and they've got things on them that perhaps are very difficult to explain. I think the easiest one I can refer to is a client who had what I would consider to be a slightly abnormal level of gambling in their bank statements. And whilst that's not illegal or anything like that, it does cause a problem if it looks like it's not within the means. And yeah, so anything like that's on bank statements, think about that before you actually go through the application process, because you will need to just be careful that, if you are tidying up some difficulties you've had in your life, it's perhaps best not to rush into the application process if you still need a bit of time to complete that. So it is a personal loan. It is paid out to you as an individual, the applicant, as an individual. And it's usually then allocated to the business, usually as a director's loan. So it works that way. Your personal loan will show up on personal credit searches. The startup loans process doesn't use bank loan ratios, and I'll get into those when I talk a little bit more about the growth guarantee scheme. But that's an interesting part to this is that you could effectively have 100% funding. You shouldn't, but you could potentially go that route. There are some rules, however. If you're using professional services to assist and advise and produce business plan and advise on this structure, you cannot borrow their fees. So your minimum level of contribution to the project has to at least be the fees that you're for the people that you're using to advise you. We have a relatively simple rule at the DT group, which we tend to share with brands, which is that, we would expect people to have a minimum of £1,000 personal contribution. Maybe there's some project brands where the setup costs are sort of sub 10, and maybe we could drop that a little bit. But we have a number of different reasons why we suggest that as a guidance, which I don't need to get into today. But if anyone wants to ask those questions of me, then I'm more than happy to share why we make that recommendation. As an applicant, you have 100% liability. The loan must be repaid. It is not something you can walk away from. It will sit with you until it is repaid. A real important point here is that you are not eligible as an applicant if you have previously owned a business doing a similar thing. So if you're a plumber and you run your own plumbing business and you decide you want to set up a brand plumbing business under a franchise, you can't use a startup loan because you've already run a business doing a similar thing. And it's a similar thing. So that's a really easy, obvious observation. A plumber doing plumbing. If you've got a plumber who's maybe setting up leak detection, it's not exactly the same, as I'm regularly told by people that do these things, but the lenders will consider it similar. So we do have to just be careful there. And it is one of the qualification questions we ask people on a regular basis. So that pretty much covers off the startup loans. There are a number of other quirks and factors around the whole startup loan process, which are just a little bit fine tuning and fine detail. But again, if people ask the questions later, I would be more than happy to answer them. So we'll move to the growth guarantee scheme. It's sort of I'm going to say it, it's probably the way I refer to it is like the big daddy of the two schemes. This is where it's not unlimited, but there is a much higher level of debt that can be gained here. Its history is a little bit checkered. It sort of effectively has evolved from the recovery loan scheme. There were two versions of the recovery loan scheme, and they evolved from the CBIL scheme, the Corona Business Interruption Loan Scheme, and that evolved from the old Enterprise Finance Guarantee Scheme. So EFG, as many people would perhaps remember it. So really, the way to look at the recovery loan scheme, let's forget all the stuff in the middle. It really is now the version of the Enterprise Finance Guarantee Scheme that's available. There's a couple of slight differences, but that pretty much is where we're at. It's designed to allow banks to lend where they would normally require tangible security. So all of the banks have a level of funding they're prepared to do, which they call unsecured. It is unsecured in terms of no tangible security, but they always have personal guarantees. So the directors will be signing personal guarantees. When you get above those limits, banks would require tangible security. If it's not available, so say you have a tenant, or the tangible security isn't of a sufficient size for the loan, the banks can then consider offering you the growth guarantee scheme, and it allows them to trade with you and allows these people to then access this level of funding. And let's be honest, tenancy is a growing market. There's a lot of people who are tenants in the UK. I think it's 4 to 6 million is whatever figures you get. So there's a lot of people who are taking franchises that are tenants. The bank must not use the growth guarantee scheme if it can lend a normal bank scheme first. This is part of the rules from the government because there is a part of this scheme that is supporting the bank behind the scenes. We do not want that to be the case. The government doesn't want them to be using it willy-nilly and as much as they can. They must lend under their normal commercial terms if they can first. So if they can lend normally, if they can't lend normally, they can then offer the growth guarantee scheme. So a little bit more about it. This definitely requires a business plan. It needs to be a professional standard. I'm not saying it has to be done by professionals. It certainly doesn't, but it needs to be of a professional standard. The lenders require this because it saves them a lot of time and because they then get every piece of information that they need to be able to make the lending decision. It's quite difficult for a bank to provide a funding decision if they haven't got everything they need in a business plan that explains what this particular proposition is all about. It needs to cover all the required elements: full background, project narrative, startup costs, minimum of 3 years of financial projections, household budget, a bit like the personal survival budget. And then you've got added things like a risk analysis, risk mitigation, SWOT, contingency planning, and more. There's equipment lists, there's marketing, there's territory details, and so on. All this needs to be in a business plan that a bank would reasonably expect to see. Personal bank statements can be asked for. They're not always asked for. So there are differences amongst the banks. One lender requires 6 months of personal bank statements as a standard. Other lenders may or may not ask for 3 months. It all depends. So it's not quite as simple as with the startup loan process. And of course, if you are in a situation where you need to provide 6 months of personal bank statements, again, we do need to just be careful that there's nothing in those 6 month statements that asks questions. It doesn't mean to say that there's anything wrong in them, but you need to just consider that when you're an applicant. So going through a little bit more, I mentioned ratios earlier. We talked about the fact that the startup loans process doesn't require a loan ratio. Banks run loan ratios. So basically, they will consider a sector, consider a brand specific in some cases within sectors. It's also relevant to whatever loan products they have, and these days also the security level. So we have a situation where you could potentially have a brand on a different loan ratio with a bank, depending on whether the client is taking a security loan with tangible property or the growth guarantee scheme. So there is quite a lot of factors here that we have to consider. And it's usually the case that if there is a difference between the security and the GGS, it's usually the case the GGS ratio is lower. Banks will take the view that offer this type of situation, they take the view that having tangible security is a more comfortable position for them. So this matters. And by loan ratios, I'm talking about capital to bank loan of say 50-50. In some cases, you can go as low as 30% your capital and 70% bank. And there's a couple of brands out there that enjoy perhaps different terms as well. The rate comparison here is that we're looking with growth guarantee scheme sometimes as low as 7.5, usually somewhere around the 8.25, and up to 9%. What's really intriguing is competition has crept into the market on the growth guarantee scheme. So we do have a difference in rate proposition across the 4 banks. And one of the banks does the rate based on risk profiling rather than just on product. So it is a really interesting situation that we're in. And it does ask the question when you are looking at growth guarantee scheme, and maybe you're a brand that deals with just one bank and most of your franchisees are using growth guarantee scheme, is that the one bank that's offering the best rate? I would suggest now that brands should not be linking themselves to just one bank, have a relationship with more than one bank. So it's a business loan in the business name. There is a minimum requirement with growth guarantee scheme for personal guarantees. The reason I say it's minimum because there can be a combination of growth guarantee scheme and security, but that's a little bit more complex and not really for today. But basically, when you've got the minimum requirement for personal guarantees, the one thing that a lot of directors don't realise is that these guarantees are joint and several. What that basically means is one person in a 2-person business could be liable jointly, but also in their own right for the full debt. So that is very worth being aware of. You can't actually have a debt of 100,000, have 2 directors, and have each director limiting their guarantee to 50,000. It doesn't work like that. There's usually a debenture put in place, and a director's loan postponement is required. The reason for that is the banks want to know that they're going to get their money back before the money that the investor is putting in is paid back to the investor. So that can work. Eligibility for growth guarantee scheme can be tricky. So there are ways that we can look at the proposition, look at the structure, look at how the business is built, and work out with the security available from the directors and the owners whether or not a different structure would mean eligibility to GGS or whether it would preclude eligibility to the GGS. So it is something that we have to work on, and it all comes out of having a really good qualification process with the franchisee, so that you can work out at the very, very beginning what your likely funding solutions for that franchisee can be. The directors do have 100% liability. There's a very, very common misconception because people feel that the growth guarantee scheme is government protected, government backed. On the website, it talks about the government providing a 70% guarantee. This guarantee is to the lender. It is not a guarantee for the individuals taking the scheme. So as a director of a business, the business will take the loan, you will sign a personal guarantee, you will remain 100% liable for that debt. In the event that the lender fails to get their money, there's a mechanism behind the scenes that the lenders can use with the government. I've not yet managed to have a proper discussion with any lender as to whether or not they've managed to use it yet, but anyway, that's a conversation perhaps for another opportunity, or maybe the BFA conference when we get hold of some lenders in the evening. But look, that's how it works. So those are the two schemes that I was asked to run through. Slightly exciting startup loan scheme designed for the lower entry level brands, and then perhaps growth guarantee scheme is perhaps more suited to the slightly higher bracket upwards. So in summary, both schemes work well. Absolutely, both schemes work well. We see an awful lot of work on both schemes. However, they are unlikely to be used together. You can use them together, but it is unlikely, and there's something we can talk about that perhaps following this summary. Business plans do need to be comprehensive. Even if you're using the startup loan template plan, you do need to take the time and trouble to make sure that what you put in that template makes sense, adds up, all the figures work, and that you're not going to have a problem going through the application process. Startup loans are pretty much now reviewed in a similar way to bank loans. They're done a lot faster, and I know this is being recorded and the banks won't like me saying this, but they can do it a lot faster than the banks, but it is a lower level of lending. So it is, to be expected. So, but they do review in a similar way. They are looking at the same sort of principles. So eligibility can be complex for both schemes. As I've already illustrated, there can be different reasons you can or can't be eligible for either of the schemes. And there's a certain amount of planning you can do to either gain eligibility or to avoid being eligible. So it is something you do need to look at very carefully when you're looking at the franchisee setup in your brand. There are flexible options. We have many things that you can do here. The way that the loans are used, we've got up to 6-year term on growth guarantee scheme, which we can use. We don't have to, but we can. But the 6-year term can only be used if the franchise agreement has a term of at least 6 years. And if there's premises, the premises lease agreement cannot have a landlord break clause within the 6 years. If it's 5-year landlord deal or 5-year brand franchise agreement, you can only have 5 years with GGS. There's a whole bunch of stuff you have to really consider at the early stage. So, a little bit of a plug, but professional advice is advised. And I will say it, the people that work within this industry and offer this sort of advice, they are worth it, because there's so much going on here that you really, as a brand, would expect your franchisee to be given the best possible solutions, the best possible advice, so they've got the best chance of success. It really is important that is considered as something that you really, really should do. And it's not an expensive process. So I'm going to open up, because I've hidden you all because I couldn't see my presentation, but there you go. See if, oh, no, you are all still awake. So that's perfect. So I think probably the best thing to do now is to see if you've got any questions at this stage.
Simon, I know you've put a question on, so would you like to start?
Sorry, just finding my that was really interesting. Thank you. I think one of the things that stood out for me is I know a lot of the children's services franchises leverage these facilities, but one of the things that you said would require them to be ineligible is where they're receiving a commission or not a direct payment from the customer. So the question there is, with the growth of more centralized booking systems like Pebble and Franscape, where they take where they take the royalty at source, would that render those types of businesses ineligible for the loan?
Yeah, I'll give you the view I have as to why this is in place is as a lender, you want to know that the person you're lending to has the ability to prioritize payment to you because you're an important part of their business. If you've got a situation where a franchisee business is receiving 10% of the revenue, right? Hello? Sorry, rather than 100%.
Sorry about that.
Sorry, I wasn't sure what was going on there. So if you have a situation where as a lender, the business you've lent to is only getting a 10% of the revenue instead of 100% of the revenue, then your client has less opportunity to prioritize paying you. So the reason that rule exists is so that the franchisee can prioritize paying the startup loan company rather than paying somebody who's, a staff or other people's debts. So you're right. The children's sector is an interesting one, and you possibly know some because you know us. The DT group is very big in the children's sector. We do a lot of it. You do have this come up quite a bit, and we've actually got it in the cleaning sector as well. There's a couple of small cleaning brands that also have the same challenge, and I've got a car finance brand that's got the same as well. But there are ways round it. So if you've got a central booking system, there is a possibility that you can structure the way that system works so that it doesn't take the money directly. Now, you're getting into an area here where we charge fees for advice. So I would suggest I have an off the record conversation with you as to whether or not we can help you. But there are ways around it. There's a little bit of jiggery pokery with how the system has to be set up. But there are ways around that. Now, what you have to do though is adhere to the principle that 100% of the revenue is paid to the franchisee company. That's the important bit. And as long as that rule is adhered to, then you can have ways of supporting that franchisee company centrally, as long as that mechanism happens. So it is a challenge though, and we had a brand come to us not so long ago, and they changed the system to make sure that this happened. Does that help?
Just
Yeah.
a quick,
Sorry, Ken, yeah.
yeah, just a quick question in terms of timing, because going back to the beginning, when I mentioned one of our clients, we were managing to take them through the government startup scheme, but it was taking a good 6, possibly 8 weeks. Whereas since we've started working with you, that time's been significantly reduced, which, as I said, in connection to recruitment, speeds up that process from the point where the franchisee's committed to the point where they can actually start operating the franchise. So from a time point of view, and clearly I understand it's flexible and depends on a number of things, but just as a guide for other people who might be interested, what sort of timing would you put typically on an application?
That's a good question. The process that we would expect to do, if it's a brand we already work with, we can have this from introduction of the client to submission to startup loans, 2 to 3 days. From the point at which that's submitted, we would expect a decision back from startup loans in 3 to 4 weeks at the moment, as an average. Some of these go through quicker. There's a very definite tendency, depending on how busy the providers are. The one thing that I didn't allude to, because it's not about what the DT group, this presentation is a general conversation, but because we are linked to one particular delivery partner, we'll always ask our clients to use that particular delivery partner, and we can influence the process a little bit. Not a lot. There's a phrase there we could use, but we're not going to go there because it's a long time ago. But not a lot, but we can. But yeah, 3 to 4 weeks is an average. So what's it? First week of September. If you gave me a client today, you should have them with money by the end of September-ish, on average. So.
Okay, thanks.
Phil,
It was just. Oh, sorry.
sorry, was that you, Simon?
Yeah, that's all right. You crack
Sorry,
on.
you carry on.
No, no. I guess you know what I'm like. I always like to look and expand on the broader issues here. Um, this is great, but are we not as an industry, if we're leveraging this too much, in danger of putting too many underfunded franchisees into the industry? Because you're saying that you can lend up to 100% of the costs, and there are lots of franchisors that leverage this system a lot to get people into the network. And I'm just
Yeah.
not
I'm
convinced it's the right message to be putting out about
no,
franchising, particularly
no,
with
no, 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 Simon. I really appreciate you making that point because that's not what I was saying. In theory, the scheme can be used at that level.
yeah,
We would never advise it would be used at that level.
yeah,
In reality, I would expect clients to have at least 30% contribution. But there are occasions where we've accepted a £25,000 applicant with £1,000 of their own money because they're sitting on a huge property situation, they've got other means. There's so many different factors that come into the process. But what you're saying, I totally agree with. You really, really have to be careful not to underfund people and overstretch them with lending.
yeah.
Which is why the banks have lending
It's not
policies.
just from a financial point of view, but and Natalia will bear this out with some of the litigation we're seeing now. A lot of the judges are drawing, you know, are looking at the franchise or franchisee relationship as an employer employee relationship around good faith and everything else. And it just seems to me that, again, I just feel there's a danger in people over borrowing
Yeah.
and coming into franchising underfunded for all sorts of reasons.
I'll tell you where we get the higher levels of funding is with some of the brands where it attracts the younger franchisee. They haven't had the opportunity to raise too much in the background, but they're living at home
Yeah,
potentially. So their outgoings are lower. The brand model works based on only having costs if you have revenue. So you've got a situation where there's no real fixed costs. So sometimes it is appropriate to look at it, but generally speaking, your point is absolutely bang on. You've got to be careful. One of the other reasons we say you should have at least £1,000, I want to know these people have got the ability to save a bit of money. Have they had good fiscal management in the past? They're about to run a business. They need to be able to add up and use their knowledge and ability to run a business, which means if they haven't managed to save £1 a month for the last few years, why not? There are, I don't want to get into too much of the nitty-gritty, but we are a professional services company, so we're not just here to sell loans. That's not what we do. So we want to give these people best advice, look after them, and keep them in good financial health going forward. So yeah, I think there are occasions where you could do it, and I've explained that. But generally speaking, I would totally subscribe to your point. Yeah, we really do not want to be 100% funding businesses.
yeah. I mean, like I said, it's just an observation. There are a lot of franchisors, particularly in the children's sector, who are leveraging the availability of these schemes to get in franchisees that don't have the money to do it.
Yeah.
And it's all very well, as we all know, being able to buy a franchise, but to enable it to grow, you've got to have working capital.
Yeah.
That is the key to success in franchising. Trust me, I've been there.
Yeah.
You
Well,
know,
I would be pleased to say, I mean, the brands that we work with, we have only a couple of situations in the last 6 years where we've done 90% funding using a startup loan. The majority don't, and that is only a very small part of what the scheme is there for. Most people, I had one this morning I was chatting to. It's a 20 grand brand and put 10 grand in, and we're doing 10 on startup loan. That's
Yeah.
more typically what we get to see.
okay,
So
that's encouraging. As I said,
and
I mean, that's not what I'm seeing in the public domain. As I said, it's quite, you do see a lot of advertising and promotion around the factors. Look, don't worry about not having any money. You can still come into this because we can get 100% funding for you. I just think that is dangerous, really
it's
dangerous.
dangerous, and it's down to us as an industry making sure that those brands are told that it's dangerous. I mean, if a brand comes to me and says predominantly I want everyone to have 100% funding, and I don't agree with that, I won't deal with that brand.
Mm.
As simple as that. I mean,
I think as well. I mean, I agree completely, Simon, with both you and Phil. But just, for the purposes of this discussion, I'd want to see and expect the franchisor acting in a sensible way as well, in terms of who they take on and the caliber and the funds available of prospective franchisees that they put, not just to Phil, but to any lender. Because I think the irresponsibility starts there, frankly.
And I think we've all learned this week, haven't we, that if you're using a professional advisor, it's best to give them all the right and relevant information. Otherwise, you might not get the right advice. I think that's my topical point for the week.
Phil, one sort of last question, I think. Well, there's two actually. One is how important are the high street banks in all this? Should franchisees still look at high street bank funding first? And the second question was, do you think, based on your extensive business experience, we'll ever get to a point where, 10, 15, 20 years ago, the government were handing out grants to new businesses? Do you think we'll ever go back to that sort of situation?
We'll go into the grants first. There are still grants available now from local authorities, different reasons and so on. So, but no, I don't think we realistically today in current circumstances could envisage a situation where grants come back into the mainstream to replace something like these schemes. Your first question about the banks, I don't want this to come across like startup loans are the most important thing. They are not. And they have a place in the market, and the banks very much operate with that place and beyond. So you get a situation, I mean, and again, this is the sort of thing that we get into that's commercially sensitive, but you could have a situation where a client could choose to use startup loans or could choose to use the bank. And there are reasons you would make a decision as to which route you go in every single case that are different. There are some quirks around startup loans for example, if you're using them for a repurchase, which you can do because you as an individual are first into the business, it's not your business previously. The startup loan people want the sales agreement completed before they will then make a decision of approval. So whereas a bank will give you an agreement in principle. So there are some reasons why you would perhaps go the bank route first. The flexibility of the banks in terms of what other services they can offer in terms of things like VAT loans, can't do that with a startup loan. So again, if one of the reasons you wouldn't potentially go 100k of startup loans for a business is because you've probably got 20k of VAT to pay as well. Or more, because you probably wouldn't be 100% funding, as Simon's point. So there are so many different reasons why you would consider different options here. And I think that's why I hope everyone looking at this presentation thinks that, it's not a sales pitch to use professional advisors. It's a very, very complicated area. And as a brand, you need to concentrate on your brand and what you achieve as a brand, not on how you deal with funding.
Brilliant. So, does anybody else have any further questions? No?
I
Ken?
haven't had the
No.
most frequently asked question yet.
Oh, right. What
No, because
what would that be?
there is a most frequently asked question, and because there's a most frequently asked question, I did a slide on it.
All right, please go ahead.
So please allow me to answer the most frequently asked question. The most frequently asked question is, can I have a bank loan and a startup loan? The answer is yes, but basically, and this comes up so much, basically, you cannot use the startup loan as part of your capital when you're dealing with the bank. So if you have an example where there's a £100,000 project and you have a 50-50 ratio with the bank, you will need 50,000 of capital. The bank will lend you 50,000. You can't borrow 25 grand on a startup loan and put only 25 grand of your own money in. So just to be really clear about this, you can use a startup loan with the bank, but the bank will always view the startup loan money as loan money, not capital. So that is the question I genuinely thought would come up, because it comes up with almost everybody I speak to. So I'm not saying you failed me today, audience, but I was ready for you.
soon as I saw that question, I thought I could feel Simon's blood sort of pressure rising as he sees all these loans coming through from an individual point of view. But anyway, Ken, do you want to finish off then?
Yeah, thanks, Phil. Really interesting. I hope everyone's found it useful, and we look forward to seeing you again, and we'll be in touch regarding the next First Friday session.
Brilliant. Thanks, everybody. Really appreciate your time, Phil, and thanks to Simon and Natalia. Have a great weekend, everybody, and we'll see you next time. Thank you. Bye.
Thank you.
Thank you. Bye.
Thank you.
Bye.
See ya.
Bye.
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 Phil, can you hang on?